Account receivables. We all know what account receivables are. Account receivables are our customers to whom we sell goods or services on credit. So we sometimes call them trade receivables, sometimes account receivables. So these are our customers, individuals or firms from whom we have to receive some money for some goods we have sold to them, or maybe we would have provided some services to them. Now, there are two types of receivables, current and non-current. Current account receivables mean these are the customers to whom you have sold goods or services, and they are most likely to pay with you within 1 year or operating cycle. So current account receivables are your current asset reported as a part of your current assets, and non-current receivables mean these are the customers that will pay you after 1 year. So how do we report current account receivables? This is how we do. Let's say you have sold goods or provided services to the customers, and on the balance sheet date, this is the amount due from them, 105,000. That's the gross account receivable. And we are little doubtful that maybe out of these $105,000, $5,000 worth of account receivable, they may not pay you. They are more likely uncollectible. So 105 is the gross amount, 5,000 is the amount that we may not receive. That means the net realizable value, the amount that we are likely to collect net, is $100,000. This is called the NRV. So remember, account receivables are reported at NRV. And what is NRV? NRV is net realizable value. That is the amount gross less the amount is unlikely to be collected. The net amount we are going to collect is called the NRV. That's what we do with our account receivable. What about the customers from whom we are going to receive money after more than 1 year? Non-current receivables. How do we report these? Let's say I have to receive some money from the customers after 2 years, and the amount happens to be $15,000. Right? That will be collected somewhere at the end of 2023. Jiva Kas Walaikum Salam. Khizr says, is there any type of allowance means different names? You call it provision for doubtful debts, Khizr. Provision for doubtful debts, that might be the old, like in your undergraduate courses or maybe in your ACCA or CA courses. But in the US, we call it allowance. It's the same as provision for doubtful debts. So we call it allowance for uncollectible accounts. Just the name is different. So let's say if you are expecting to receive $15,000 in 2023, way back after 2 years, we report this amount after discounting, and maybe after discounting at a certain rate, it will appear as $13,000. So this is what you call the present value of future cash flows. Instead of writing the gross amount, which is due after 2 years, you bring this 15,000 to its present value through discounting. We'll discuss discounting later on, but right now, this is the amount at which you will report to your on your assets, account receivable that are non-current. That means they are likely to be paid off after maybe more than 1 year or 2 years. Okay, now this is important. This is the most important part. When some of your customers are unable to pay you, they are more likely to go bankrupt, or maybe they refuse to pay, what you do? Normally, what you would have done so far, some of you, that's the entry you pass. You debit the bad debt expense, actual bad debt, and you credit the customer. Legal action is, yes, of course, that is one of the ways we do it. Bad debt expense debit, actual bad debt, and you credit the customer who refuses to pay, and then his account is closed. This is called the direct write-off method. This is not permitted under the IFRS as well as US GAAP. Direct write-off, it is not acceptable under US GAAP. Why? The reason being, maybe the sales relates to 2020 and the customer refuses to pay in 2021. So the sale, the revenue was recognized in 2020, but the customer goes bad in 2021. So that violates one of the basic accounting conventions of matching concept. It violates matching principle. Matching principle means, yes, absolutely was 2020 revenue must be matched with 2020 expenses. So this bad debt actually occurring in 2021 relates to the sale that was made in 2020. So we shouldn't be charging this bad debt in 2021 because it violates what you call the matching principle. Then what to do? This is what we do in tax reporting, tax purposes. That's what we do. In tax purposes, when the debt actually goes bad, only then you write it off. For tax purposes, this is fine. For tax purposes, this is fine because tax will consider it as a valid expense when the customer actually goes bad. But in US GAAP, under IFRS, you are required to follow the matching principle. Means the expenses and revenues must be matched in the same period. Like if the sale is in 2020, then the estimated provision, absolutely allowance or provision must be made in 2020, right? So let's do a question first. The following information has been compiled by a manufacturing company. Sale of company's products for the period to customers within net 30 days terms amounting to 150. Credit sales, okay? Sale of company products for the period to a customer supported by a note of $25,000 with special terms of net 180 days. Since this sale is special sale and against which we have already received a note, technically he has given us some consideration which will be materializing in the coming time. So technically it is not an account receivable. We will debit this note receivable and credit sales. Mafi customer debited, customer isn't there. He has given you the note. So this is totally unrelated to your credit customers. Only this part so far. Then balance of trade receivables at the end of the last period was $300,000. This is the opening balance of your receivable, the amount due from our customer in the last year. Collection of open trade receivables during the period was $200,000. This is the amount we have received from our customers. Rental income for the period, both earned and accrued, but not yet collected from the manufacturing company's credit union for use of company's facility. This is what we are expecting from our from renting of our facility. So this amount is receivable. This is not trade receivable. We're talking about the trade receivable, the receivable that arises because of the sale of goods or services. Yes, note here, you have received a note receivable, which is treated like an asset. You debit your note receivable and remove the customer from the books. So basically it is not, this amount will not be considered as a credit sale, right? Because you have received some consideration, something in value in return. What the question says, the open trade receivables balance to be shown on the statement of financial position for the period is, first of all, your opening balance is $300,000. During the period, you have made sales of $150,000. That means the total amount due is $450,000, out of which we have already collected $200,000. So that gives you $250,000. This $2,000 should not be considered, Wakas. This is the rental income due from some other party. They are not our trade receivables. Remember, you have to distinguish between trade receivables and other receivables. We are specifically focusing on trade receivables, so that would make 250A to be the correct option. Wakas, please. This is amount due, not from our trade receivables. So this is excluded. Take only the amounts relating to your credit customers. Yes, A is the right answer. All right, so that's the concept we got so far. Next. So what we do, we have to follow the matching principle. If we have made sale in 2020 or 2021, this revenue must be matched with expenses in 2020 or 2021, right? If you have made sales in 2020, you must match the sales against expenses related to that sale in 2020, not in 2021 or 2022. So we are going to make an estimated allowance for bad debts, allowance for uncollectible accounts, provision for bad debt, whatever name you want to call it. But in the US accounting literature, we use allowance for uncollectible accounts. The dynamics stay the same. There are two methods for measuring bad debt expense. One is called the income statement approach, also sometimes called the percentage of sales method. Other is called the balance sheet approach or called the percentage of receivables method. Let us discuss the first one, income statement approach. Under the income statement approach, what you do, you take your credit sales and charge a certain percentage of that credit sale as an estimated allowance for uncollectible account. Under the income statement approach, bad debt expense is calculated as a percentage of your credit sales. Which credit sales? The sale that is reported on the income statement. Let us take an example to make things more clearer and easily understandable. A company's year-end unadjusted trial balance reports the following amounts. We have gross receivables of $100,000. allowance already available in allowance for uncollectible account, $1,000. Okay. Sales on credit, credit sales, $250,000. Since we are doing the income statement approach, so we are going to take some percentage of this amount as our uncollectible account receivable. So let's say, according to the past experience, 1% of the company's credit sales have become uncollectible. That's the past trend. 1% of our credit sales doesn't actually materialize in cash. The company uses the income statement approach to calculate bad debt expense. The bad debt expense recognized for this year is going to be just 1% of $250,000. That is $2,500. Now, ladies and gentlemen, listen to me very, very, very carefully. Under the income statement approach, whatever amount you get, ignoring completely what is the existing balance in your allowance, you simply make this entry: debit your bad debt expense and credit allowance for uncollectible account, or if you want to call it, provision for doubtful debts. Bad debt expense debit, provision for doubtful debts or allowance credit by 1% of credit sales. We totally ignore what was the balance available in the allowance for uncollectible accounts. Right? So what happens now? This $2,500, it goes to your income statement as an expense. And this $2,500, a credit balance, adds up to this credit balance. 2,500 credit, 1,000 credit, total credit balance in your allowance will be $3,500. Right? So this 2,500 goes to income statement. Now, one important point you need to understand right here. This bad debt expense is the bad debt estimate. Yes, he can pay you in the future, but that will be discussed in a few slides later. Bad debt expense here, I have charged this 2,500 to income statement. This is estimated bad debt, not the actual bad debt. Please make very clear distinction between the bad debt expense or estimate and the bad debt actual. We'll discuss this in a little while. So now this 2,500 goes to income statement as a charge, as an expense, so that it can be matched against the current year revenue. Fine, makes sense. And the credit part, 2,500, adds up to the existing balance of your allowance and gives you a total balance of 3,500 in your allowance for uncollectible accounts. How do we report it? This 2,500 goes straight to income statement. What about this 3,500? This is reported this way. You write your gross receivables, that is $100,000. And from this gross receivable, you deduct the new revised balance of your allowance of 3,500, and you show 96,500 as your net account receivable. Gentlemen, ladies, this is what you call the NRV, net realizable value of your account receivable, gross less allowance, 96,500. Right? So please, important point here to be noted. In the income statement approach, you totally ignore the existing balance. You take the sales figure, apply the percentage, tuck, make the entry. But that's not going to be the next case. Hasib, ECL, what exactly do you mean by that? Let me explain the term in detail, if you could just elaborate further. Second approach is the balance sheet approach. Under the balance sheet approach, we take a little different track. Under the balance sheet approach, what we do, we set a certain percentage, like 6%. And then we apply this percentage to the available balance of your account receivable. So remember, under the balance sheet approach, we take the percentage and apply that percentage to the existing balance of your receivable. Let us read this example. It will make things much more clearer. Using the data from the previous example, assume that the company uses the balance sheet approach, and that based on the company's experience, 6% of your account receivables are determined to be uncollectible, 6% of account receivables. So this is clearly a distinct approach where the percentage is applied on the balance sheet numbers. Okay, 6% of your account receivable. What was the balance in your account receivable? Here it is, $100,000. So 6% of $100,000 is going to be 6,000. Now listen to me very carefully. This $6,000 is what we want to be the balance in our allowance for uncollectible account. Now look at this. This figure here, $1,000 already available in your allowance account, $1,000. This $1,000 credit balance, and you need an additional 6,000. You need a total of 6,000, which means if you need a provision for 6,000, as a balance of allowance for which we already have 1,000 available. So we will make the entry for net amount $5,000, right? 6,000 is what we require as a 6% of account receivable. Remaining 5,000 is what you are going to post as your entry. You're going to debit your bad debt expense, 5,000, and you credit your allowance for uncollectible account. Now, why did we do that? Because now under this entry, again, what happens? This 5,000 goes to your income statement as an expense for the period. And this 5,000 goes to the existing balance of your allowance and gives you a total balance of $6,000. And how this 6,000 is reported? Same way. Your gross receivables, $100,000. And from this, we deduct 6,000 and you get 94,000 as your net receivables. Now, what we have done in the previous question, ladies and gentlemen, we just charge a single percentage, 6% of your account receivable. That is pretty unusual. Why? This is not what we do. Rarely we use just a single rate for uncollectibility of all accounts. Why? Because some customers are old and it is probable that most of this amount might be uncollectible. And to the customers who have just sold goods recently or services, so you apply less percentage to such customers. So let us just see what it's all about. Using the data from the previous example, assume the company uses the following aging schedule to determine the ending balance of allowance for uncollectible accounts. So these are the customers breakdown: 70,000 less than 30 days old, 18,000 between 30 to 60, and then 10 and 2. Now, as per the common logic, the debt that is older is more likely to go bad. So we will charge a higher percentage for this. And the debt or the account receivable that is just recent, we just sold goods or service to these, is less likely to go bad, so just 2%. So multiplying these estimated uncollectible percentages with the amount, this is the amount you get. You will follow the same approach. Again, gentlemen, this is the balance sheet approach. Why? Because I am using my account receivable balances and I am applying differing percentages based upon the different ages of the account receivable. So I need $4,000 as my balance of allowance. Under the balance sheet approach, we compare it with the existing balance available, credit balance. So 4,000 we need. If already 1,000 is available, so we are going to charge an entry for 3,000. We'll debit the bad debt expense for 3,000 and we credit the allowance, and it works exactly the same way. This 3,000 goes to your income statement as an expense for the period. And this 3,000 is added to the $1,000 and the provision balance will now be then 4,000. And how do you report it to the balance sheet? You write your gross receivables, $100,000. And from this, you deduct the new balance of allowance. $96,000 is your net realizable value of your account receivables. Okay, now let us do a question that should... G, please.
Can you please repeat that slide, please?
Now, a company had the following account balances at December 31st. Account receivables, 900,000. This is the balance of your account receivable. Okay. Allowance for uncollectible account before any provision for the year, or allowance for uncollectible loan. This is the existing balance in your allowance. Credit sales for the year were 1.75 million. All right. The company is considering the following methods for estimating uncollectible accounts expense for the year. Based on the credit sales, 2%. Let's deal this first. Based upon credit sales, 2% of your credit sales. And if we do the computation, and if someone can get my calculator, I don't see it anywhere near. All right, so 2% of 1.75 million is 35,000. So what you're going to do under the income statement approach, we have two approaches side by side, income statement approach and the balance sheet approach. So under the income statement approach, you're going to debit the straight away amount you got. You debit your bad debt expense of $35,000, and you credit your allowance for uncollectible accounts, $35,000. What about the balance sheet? In the balance sheet approach, you take 5% of your receivables. There is a 900,000 times 5%. It's going to be 45,000. So that means if I need $45,000 as a balance in my allowance, and for this we already have 16,000 available. That's what we do in the balance sheet approach. If we need a $45,000 balance in allowance, 16,000 is already available. That means we are going to charge 29,000 only. So we'll make the entry bad debt expense debit with the 29,000, and we credit the allowance for uncollectible accounts. It's going to be 29,000. So that was the question. What amount should the company charge to uncollectible account expense? Mind the word uncollectible expense under the income statement report and balance sheet. So yes, that's true. That is 16,000 and 29,000. 16,000. This 16,000 is credit. All these are, see, before any provision, this 16,000 is the available balance in your allowance. Otherwise, had it been a debit, he would have clearly mentioned. There is just one question, not in line, not in Wiley, but in Hawk. Now, this is interesting. Gentlemen, listen to me very carefully. Ladies, please. There is just one question in Hawk and not in any other software where you find a debit balance in allowance. Debit balance in allowance means your 16,000 has a debit balance, means your provision or allowance is overcharged. Now, what you do in that case? You will have to, under the balance sheet approach, under the income statement approach, entry stays the same. Ibrad, especially for you. Absolutely, Ahmad, absolutely right. If 16,000 is the debit in your allowance and you need a $45,000 balance in your provision, so you are going to add 45 plus 16. You are going to charge a larger amount so that after deducting 16, you have exact amount available. I hope you got the idea. You need to increase your provision to such a way that after neutralizing this debit balance, you still have $45,000 available in your account, right? So the entry in that case is going to be 45 plus 16. You're going to make entry for $61,000 debit to bad debt expense, and you credit 61,000. What this entry will do, this 61,000 credit will neutralize this 16,000 debit, and net amount will be exactly what we want, $45,000. Absolutely, you guys got it right. So that's D. D is the answer. So I've just told you that when you want to write off a customer, you will first have to create a provision. And what entry do we make when we write off a customer? When you write off a customer means the customer is not going to pay, he has gone bankrupt, or maybe he has just straight away refused. We're going to take some legal action, and it is unlikely that we're going to collect the amount. You're going to post this entry, you're going to debit the allowance and credit the account receivable. Now, please note, this is something very fine. This entry does not affect your income statement. This entry does not affect the net balance of your current assets. In other words, your balance sheet and your income statement, they are not affected by this transaction. Why? Because account receivable is a balance sheet item. Allowance for uncollectible account is balance sheet item. They adjust in such a way, both of these, that the net balance of your current assets stay the same. I will explain this concept in the next slide, just a minute. So remember, this entry is what is required under the US GAAP. You do not write off your customers directly. This is the entry you pass if the customer goes bad. Debit allowance, credit account receivable, and there is nothing in this entry that affects your income statement. So income statement is totally safe, immunized against any bad debts. Now, what happens if a customer which you wrote off as a bad debt, Ahmad, you are right, a customer you wrote off as a bad debt, he comes back. His conscience pushes him to come back and pay the money. Zamir ja gaya hashir. When a customer who has refused to pay, we wrote off his account, he eventually comes back and he wants to pay us now. In that case, it is not going to be our income. Absolutely. We are going to reverse, we are going to debit the cash. That's what you're going to receive, and credit the allowance. See, in this entry again, there is no impact on income statement. There is no impact on the net effect on the balance sheet. I will show you. So the important point here you need to note, when you write off a customer, or when a customer who was written off pays you back, you collect the money from a customer who was written off. Both of these transactions, they do not affect your income statement, and they do not affect the net amount of your current assets. Now, how does it happen? Let me show you. Let me show you through the help of this example here. A company uses allowance for uncollectible accounts method to account for uncollectible accounts receivables. After recording the estimate for uncollectible accounts expense for the current year, the company decided to write off in current year 10,000 of account receivable of a customer who had filed for bankruptcy. So this customer is not going to pay. He has filed for bankruptcy. So this amount apparently is a bad debt. What effect does this write-off have on the company's current net income and the total current assets? No effect, no effect. That's just what I've told you. Because writing off a customer, it doesn't affect your net income. It doesn't affect your total current assets. That was so convenient. I have to now prove it that this is so. Let us take up some numbers to bring the point. Let's say first, before the write-off, I am going to write up my current asset section of the balance sheet. My current assets, for the sake of simplicity, I have my inventory. These are my two columns. Please, gentlemen, pay close attention to what I'm doing. Inventory balance, let's say it's $100,000, right? Your account receivables total has a total balance of $150,000, okay? And my allowance for uncollectible accounts, it has a balance of, let's say, 40. This is before the write-off. So 150 less 40 gives me 110. So the total of my current assets is 210. Now, when I write off a customer, you just saw, when you write off a customer, the entry you pay, you post to your journal, you debit the allowance for uncollectible accounts, and you credit your customer account receivable who is not going to pay. So the debit allowance and credit customer. Now I have to bring this up and I have to revise my my balance sheet section of current asset side. So this is after the write-off. After the write-off. What you see from this transaction, allowance is not an income statement item, Vakas. Account receivable is not an income statement item, boss. So income statement is not affected. That's I'm absolutely sure. I want to make sure whether my current assets stay the same. I should get 210 after writing off the bad debt. Okay, now, what is going to happen? Your inventory stays the same because inventory has not been affected. Your account receivable, since they are being credited, so they will reduce to 140. And your allowance for uncollectible account, it is being debited by 10, which means it will have now a balance of 30. Which means 140 less 30, 110. See, the magic of accounting. Your net current assets stay the same, or the total current assets are unchanged. They were 210 before and 210 now.
Excuse me, sir. Excuse me.
Okay, now let's bring in a situation where a customer who was written off, he pays you back. Customer whose account was written off, he comes and pays you back $10,000. So what you're going to debit, you're going to debit your cash or bank, and you're going to credit your allowance, right? That's the entry we discussed a little while ago. So let's say this is the situation before the customer pays you. Inventory, we have 100,000 account receivable, 150, allowance 40, and bank 10, so total 220. Now the customer pays you, the entry you passed, just saw a little while ago, cash or bank is going to be debited with 10,000, and you're going to credit your allowance with 10,000, right? That's what you're going to do. So inventory stays the same, your AR stays the same, 150. Your allowance is being credited. When allowance is being credited, means credit and credit combined, you have a 50,000 number in your allowance. So the net figure becomes $100,000. What happens now, gentlemen, ladies and gentlemen, bank account has gone up by 10. So the new balance in your bank is going to be 10 plus 10, 20. Look at this. Your current assets stay the same. So when your account is written off, we just saw the account receivable is written off, your current assets stay the same, income stays the same. No effect on income statement, no effect on total current assets. And when a customer who was written off, he pays you back, a bad debt is recovered, it is not going to be your income. It is going to be debited to cash, credited to allowance. In this way, before and after collecting a bad debt that was written off, your current assets stay the same. All right, here we go. Read the information carefully. Based on the industry average, a corporation estimates that its bad debt should average 3% of credit sales. 3% of credit sales, clearly it's an income statement approach. The balance in the allowance for uncollectible accounts at the beginning of the year was 140. This is the balance already available in the allowance account. During the year, credit sales totaled $10 million. Accounts for 100,000 were deemed to be uncollectible. This amount is expected to be uncollectible. Okay. And a payment was received 20,000 on account that had previously been written off. This is the actual bad debt, and this is the amount collected from a customer who was written off bad debt in the previous periods. Now, what we're going to do, the entry to record the bad debt expense. Please remember, this bad debt expense is the estimated bad debt. There is a very massive difference between the bad debt expense and the bad debt actual written off. Bad debt expense is pointing you towards allowance, and bad debt written off is the actual bad debt during the period. Now, the question clearly tells you what is the entry to record the bad debt expense. Under the income statement approach, what you do, you take the percentage and you multiply straight with the credit sales and forget about everything in the world. 3% of 10 million, that is $300,000. This is the amount we are going to use our entry for. We are going to make this entry bad debt expense. Please remember, bad debt expense, this word, whenever you see, is the estimated bad debt. It is the estimated bad debt. Debit $300,000 and credit the allowance for uncollectible accounts, $300,000. It has nothing to do what was written off, nothing to do what was recovered. If you need to use income statement approach, income statement simply takes the percentage and multiply it with the total credit sales, right? Now, had it been, we got our answer, it's A. Had it been the balance sheet approach, under the balance sheet approach, we would have considered what was the balance. Now, listen to me, this is a beautiful question now. Now, let's say if it's the balance sheet approach, what you would do? We should be given the balance of our account receivable. It says allowance is 140, right? So what happens, gentlemen? When a customer is written off, what the entry we make, we debit the allowance and credit the customer, which means this 100,000 will be deducted from allowance. And when a customer who was written off, he pays you back, his amount collected is increased or it is credited to the allowance. Please remember, a customer that is written off, that write-off is charged against the allowance. This is it. And when a customer pays you back who was written off, his amount is in fact credited to the allowance. So the new balance in allowance is going to be, so 40, 20, 60. This is the balance in your allowance. Now, information isn't given. Let's say your account receivables are 500,000, right? And as per our past history, we need 6% of this amount. Let me take a bigger number so that it should make sense. It comes out to be 30. Let's take a bigger number. Let's take maybe 15%. 15% of our, we need 15% of our account receivable as our balance. So in allowance. So 500,000 times 15%, that is 75,000. So I need a provision for 75,000. And already the existing balance is 60, right? After adjusting for the write-off and after adjusting for the amount collected. So 75 is what I need. 60 is already available. So I'm going to make the entry for the differential, 15,000. I'm going to debit my bad debt expense. Please mind the word. And credit the allowance with 15,000. So this is the effort you have to make. If there is a balance sheet approach, income statement approach is straight. 3% of sales, make the entry and that's all. Imran, the question will explicitly, in unambiguous term, will tell you which method you have to use. Question will tell you, like in this method, it clearly said 3% of the sales. That means it's an income statement approach, right? And in the previous one, it would give you clearly what you were supposed to do here in the previous example. Under each this method, percentage of sales and percentage of account receivables, the question will explicitly tell you what you're supposed to do. Okay, now next, I'm going to give you two formats which are going to go a long way with you in solving any customer related questions. So let me give you the formats first. They will help you find the unknown numbers. So, okay, here we go. First, I'm going to give you the formats for total account receivables. What do you expect in total account receivables? You will have a brought down balance. You will have the credit sales on the debit. You will have any check dishonored on this side, dishonored check for short. And then we will have any refunds made to customer. This is the maximum format you can ever expect in the history of accounting. Refunds, or maybe if some customers are deet and they don't pay you on time, you might charge interest on overdue accounts. Interest on overdue accounts. These items you expect on the debit side. Let me label them as 1, 2, 3, and 4. On the credit side, what you expect? Any returns from our customers. They come here. Return inverse clearly. Any collection from them in the form of cash and bank, it comes here. Cash or bank. Any discount we allow to them, discount allowed. Or sometimes set off or contra, because sometimes your customer might be your supplier or your supplier might be your customer. So we just sometimes set their accounts off so as we either see whether we have to pay them or we have to receive. Netting off your supplier and customer. Let's say we purchase from Hasib and we sell to him. So at the end of the month, we just want to see how much do we have to pay or how much do we have to receive. So we net off their receivables and payables. This is called set off or contra. Okay. And lastly, the actual bad debt. Mind the word. This is not bad debt expense. This is the actual bad debt. This is a fine difference. And then after all these, you should have your closing balance. Right? Okay. Now, the second format you're going to have is your allowance for uncollectible accounts format. Allowance for uncollectible accounts. So very, very bad short way of writing it. But please remember, it's allowance for uncollectible accounts. You will have a credit balance here. You will have the closing credit balance here. Now, please listen. Please listen to me very carefully. Any bad debt expense, or what you call the bad debt estimate, bad debt expense or estimate, it appears on the credit side. Why? Because when we create allowance, the entry we make is we debit the bad debt expense, credit allowance. And this is the exact that amount appearing here. Any bad debt you recover, BD recovered, it appears here. Why it appears here? Because we just saw the entry. When a bad debt is recovered, we debit cash, credit the allowance account. The actual bad debt, the customers who do not pay us, the actual bad debt, that appears here. Bad debt actual. To what entry? I hope you remember. When a customer doesn't pay us, refuses to pay, goes bankrupt, we debit allowance and credit that customer. This is that amount. And this is exactly what you will find here. These are the same amount. Bad debt actual expense here and this bad debt expense, they are the same. They are the same. Actual bad debt, credit in account receivable, and actual bad debt, it's debit in the allowance. They are the same amounts. Now, this is totally your choice if you want to use this format of allowance, or perhaps you would like to follow this. They are absolutely the same. One is written in the T form, other is given in the statement form. Beginning balance plus bad debt expense recognized during the period, less account receivables written off, plus any collection of previously written off, you get the closing balance. You want to use this format, your choice. Or you want to use this T-count format, your choice. You can find out the unknown numbers or unknown amounts through this format. Let us apply these formats in some actual questions to see how it works. Now look at this. I'm going to first erase this and then I'm going to explain the idea. All right, people. Question 1, statement of financial position on December 31st, year 1, December 31st, year 2 are given below. We have given 2 years balance sheet. Whenever you see a bigger question, it is always recommended to read the specific requirement. It says cash collection from customers in year 2. How much cash have we collected in year 2? So that means we are just focusing on the total account receivable account. Let us plug in the numbers first. We need to have the opening balance of receivables. Do we have it? Yes, we do. Look at this. Opening balance of account receivable is 95,000 right here. And do we have the closing balance also? Yes, just opposite to the opening, you have closing 89. You report it here. All right, then credit sales. Have we been given credit sales? Yes, credit sale is 338. Plug it in. Credit sale is 338,000. Do we have any dishonored checks? No. Do we have any refunds? Apparently, no. Any interest on overdue account? No. What else are we looking for? Are there any returns? They are not a part of balance sheet. They should be somewhere here. No. Do we have any discount allowed? No. Do we have any set of a contra? No. Do we have any actual bad debts? This 3,000 is the actual bad debt written off. That is what you're going to write here. The actual bad debt written off 3,000. Right? And we are required to find out the balance or what you collected from our customer. This is what we need to find out. So basically, you are going to find the unknown number. You're going to take 95 plus 338. From this, deduct 3,000 and 89,000. You will get the amount collected from customers. So you can find unknown numbers using this format: 95 plus 338 less 3 less 89. What you get is 341. This is the cash collected from our customers, and it perfectly matches with your option A. So please remember this format. You can, yes, Vikas, you can find any unknown numbers by just following this format. Added 95, 338. There is nothing on the debit side. Deduct 3 and 89. You will find the balancing figure 341 as your cash collection from customers. Sometimes you may have to find bad debts. Use this format and you will find any unknown that you may need to require. Now, this one is a good one also. Look at this. This question says, what was the amount of account receivables written off as uncollectible during the year? Uncollectible accounts can be found out either by using the total account receivable account or the allowance for uncollectible account. We do not know which of these formats do we have to use in this question, right? Let us read this question to know exactly what we are supposed to do. An analysis of an entity's 150,000 account receivable at year end resulted in a 5,000 ending balance for its allowance for uncollectible accounts. This is the closing balance of allowance. Bad debt expense for the period was this. It clearly shows that we have to prepare the allowance for bad debt accounts. This is it. Let me plug in the numbers here. An analysis of an entity account 150 account receivable at the end of the year resulted in 5,000 ending balance in allowance. Ending balance in allowance is 5,000. Okay. It further says the bad debt expense. Please, people, note it down. This is the bad debt expense. Bad debt expense, estimated bad debt. This is what you are going to show here. During the past year, recoveries on bad debts previously written off were correctly recorded as 500. This is the bad debt recovered. You're going to show it exactly as per the format. This 500 will be reported here. It further says if the beginning balance on the allowance for uncollectible account was 4,700, if this is the beginning balance, find what is the amount of account receivables written off as uncollectible during the year. You have to find the actual bad debts. The actual bad debts, that's it. This is what you need to find out. So you're going to simply do the basic arithmetic. 4,700 plus 2,000 plus 500, and from this deduct the closing balance. You get 2,200. So this is the actual bad debt written off during the period. There is a difference between the actual bad debt and the bad debt expense. This is the estimated bad debt, and this is the actual bad debt. This distinction must be kept in mind. So that makes C to be the correct option. 2,200. All right. Next, we have allowance for uncollectible accounts. Sometimes goods are returned by our customers. So if a customer who purchased goods from us in maybe 2022 and he returned it in 2023, so how can we consider sales in 2022 and returns in 2023? Matching concept says that if sale was made in 2022, you should make an estimated provision or allowance for returns within 2022, just like the allowance for bad debts. Allowance for bad debts and allowance for sales return, they work exactly in the same way. Now, the good thing is there is no question in Gleim software for this, but the dynamics stay the same. Same thing. Provision for returns must be made in the same way as we do for allowance for uncollectible accounts. So in order to be consistent with the matching principle, revenues and sales return must be recognized in the same date. The date you sell, the same date you should charge your allowance for returns. This is it. A company has 500,000 sales in July, its first month of operations, and management estimates that total returns will be 1% of sales. Okay. If this is the sales, the entry we make is debit, cash, or account receivable credit sales. On the same date, you must create an allowance for return of 1% of the amount sold. You debit the sales return estimate, remember, and you credit the allowance. It works in exactly the same way as bad debt. When the actual returns are made, what entry you're going to make? Anybody? When there are actual returns, what entry you're going to make? Just consider it the same thing as allowance for bad debts. When actual returns come,
Allowance for
excellent. Allowance debit
allowance for
and account receivable.
sales will be debited
Account receivable credit. Allowance debit and account receivable.
and the accounts payable will be credited.
Yes, exactly. That's the right thing. Okay, if this is so, let us try this concept in this question. It says this is the opening balance of your account receivable. This is the credit sales. This is the sales return for the period, actual sales return. 40,000 account receivable written off. This is the collection from customers. Estimated future sales return 50 and estimated uncollectible 110. This is the estimated future returns and estimated uncollectible. Okay. What amount should be reported for account receivable? Remember, account receivables show the actual sales return and the actual bad debt. These estimates, they don't appear in the allowance account, in the customer's account. I'm sure you would have noticed this one. Let us draw up the account and then I will show you how it works. This is your total account receivable. Let me take you back to show you what exactly I mean here. This is it. What you see here, this sales return, this is the actual sales return. This is the actual bad debt. Where do you see the allowance or estimated bad debt? Estimated bad debts appear in this allowance account. Estimated sales return appear in the allowance for sales return. So estimated amounts, they appear in the relevant allowance account, allowance for bad debts or allowance for sales return. Actual returns and actual bad debts, they appear in the customer's credit side. All right, so moving on to this question, which we were doing, here it is. So we have the opening balance of our account receivable at 650, put it here, without the 1,000 sign. Credit sales 2.7 million, 2,700. Sales return for the year, actual sales return appear here. Actual accounts return appear here. Collection from customers 2,150 appear here, right? And what else? I think that's all. Estimated future sales return, they go to the allowance for sales return. Estimated uncollectible accounts, they go for allowance for uncollectible accounts. They don't appear in the customer account. So if you 650 plus 2,700, less 75, less 210, less 40 should give you the closing balance of your customer's account, and it appears to be 1085. That makes C to be the correct option. All right. Now there's one important area that we just don't want to miss, would like to discuss maybe in our next class. Factoring of account receivables.
Excuse me, sir.
Okay, next, factoring and pledging of your receivables. They are two different things. When you pledge your receivables, you receive money using your receivable as a collateral, you retain ownership of your account receivable. But when you go for factoring, which is a part 2 topic, section B, corporate finance, in many cases under factoring, account receivables are sold. How does it work? You make an arrangement with the factoring company, you sell your receivables to factoring company gives you cash. And this is the cash you use to run your operations, and you sell your product and service to the customer, and this cycle goes on and on. So let us discuss factoring briefly. Factoring involves transferring your receivables to a third party called a factor who assumes the responsibility of collection. Factoring company is responsible for collection. There are two ways it can be done. One is factoring without recourse. What it means, you sell your receivable to factoring company, the sale is final. If any customer goes bad, you are not responsible. Seller has no responsibility for any bad debts. Right? So in this case, if you sell your receivables are not reported as an asset in the current asset section of your balance sheet. But if the factoring is with recourse, means if any of the customers that you've sold to the factoring company, they go bad, then you are responsible. You may have to compensate the buyer, the factoring company. In this circumstance, the transfer may not qualify as a sale. There is no computation required in this part of your financial reporting area. This is an area where we have quite a detailed discussion and computation in CMA Part 2, Section B, Corporate Finance.